I'm gonna just wait for a couple more people to join. I'm chilling, bro. I'm chilling. Yeah, it was chill. I guess we can just get started now, to be honest. So he couldn't make it today, but I just want to go over market maker models today. I can go like in depth about them, so if you guys want to take notes on these, you can. So many of you guys have probably heard of market maker models. So there's going to be two kinds of market maker models. There's going to be a market maker buy model, and then there's going to be a market maker sell model. So when it comes to market maker models, there is going to be three, I guess, important parts of each model. So the first key level or area would be your original consolidation level. And you're gonna have two stages of accumulation. So if we go, so right here I'm on the daily chart on the NASDAQ. So I'm gonna go ahead and mark the yearly opening price right here. So the year opens and we have a clear accumulation from January to around the second week of April. So we have this accumulation, and as many of you guys know, the power of 3, what follows accumulation is manipulation. So we get this manipulation to the downside, and we get this change in the state of delivery right here. So once we get this change in the state of delivery, and I think there was also SMT down here, check real quick. Yeah, there was SMT down here. So how is that the SysD? The first down close candle after sweeping liquidity will be your change in the state of delivery. It doesn't have to necessarily be up here. It can also be down here, since we also formed a fair value gap as well. So this is your SMT. So this down here would be considered your smart money reversal. So taking our fib tool, anchoring it from this low to this high. So this low, since this is the low that manipulated lower before we got the change in the state of delivery, and this high, since this was the highest up close candle before we swept liquidity one more time. So this right here would be our original consolidation for a market maker model, market maker buy model. So here's our original consolidation. So you guys can see how our standard deviation projections line up with, so our -1, you guys can see how it lines up with this liquidity down here, or up here. So this would be low-hanging fruit up here. So after we have our original consolidation, every time we have an accumulation, it's going to be followed by an expansion. So we expand, and then we have our first stage of accumulation right here. This is your first stage of accumulation. After this, we manipulate lower, and I think we form an SMT. Yeah, we form an SMT right here. So we form this SMT, and if you also draw your fib tool here, you can see that the -2 to 2.5 lines up with -4 to -4.5 of our market maker model, which makes us more confident that markets will, or price will most likely reach terminus here. And we also get full body closures through -2 and 2.5. So -2 and 2.5, it's from the standard deviation level, it's a common reversal or retracement zone. But when you get full body closure through this area, price will more than likely reach terminus, which is -4 standard deviations. So we get our first stage accumulation, we manipulate lower, and then we expand. We expand, and then we get our final stage of accumulation right here, until we finally reach terminus, which is our -4 to 4.5. So this is our buy side of the curve. So each market maker model is going to have either a buy side first, or a sell side first, or a sell side first, then a buy side. So in this case, we had our buy side of the curve, and once we reach this area and get this change in the state of delivery down here, my eyes are immediately drawn to these lows down here. So I can confidently say that because price reached up into terminus and a common reversal zone, and we also formed an SMT up here with the ES. The ES kept making higher highs while the Nasdaq was pushing lower, so we form SMT right here, and we get a change in the state of delivery. So taking our fib from this high to this low, you guys can see that the -1.5 lines up with this pool of liquidity. So each one of these lows are institutional reference points. So these are also known as IPTA levels. So let me write this down. So when we get a daily change in the state of delivery to the downside, after we have completed a market maker model, price will refer to previous accumulations and their lows as reference points. So the day that we had the change in the state of delivery, which was July 17th, we look back 20 days. So we go back 20 days, it'll be June 17th. Yeah. So these lows line up. So these would be our IPTA 20-day look back lows. And then we look back another 20 days. And these would be our IPTA 40. With these ones up here. These ones would be our IPTA 40 lows. And you look back another 20 days, and these are your IPTA 60 lows down here. So we had buy side of the curve, and then we started our sell side of the curve. So this up here would be your original accumulation for your market maker sell model. Here's your first stage of accumulation. And this is your second stage of accumulation. And then price finally reaches its terminus, which was our IPTA 60 lows. And we also managed to go below yearly open. So I also want to go into the 4-hour chart because it's more clear to see the actual market maker sell model. So yeah, so we had SMT up here with ES. As you can see, ES kept pushing higher while the NASDAQ failed to push higher. So we reached up here and formed an SMT. And price also reacted off of this breaker block right here. So we can take our manipulation leg, and you can see that price eventually reaches -4 standard deviations, which was our original consolidation. So just one thing to note, when price is in its second stage of distribution, so this would be our second stage accumulation, manipulation, distribution, it'll have a very aggressive move towards the original consolidation. That's why we dumped like massively overnight on Sunday, I think it was, because price was in a hurry to get to its original consolidation, which were our IPTA 60 lows down here all the way back in April. So just zooming into the 4-hour, it's more clear to see the market maker model. So this is our original consolidation up here. And after we consolidate, we expand lower, and then we have reaccumulation down here. After this accumulation, we expand again, and after we expand, we accumulate once more. And then we manipulate and expand. So moving forward into August, I really want to see us push a bit higher, since we just swept a major pool of sell side liquidity. And we also have this unmitigated fair value gap up here on the weekly. I would prefer to see August close bearishly, so for that to happen, obviously we'd have to have an open high low close. So moving into this week, I would prefer to see prices go higher, since we also had full body closure through this new week opening gap right here. So when we have a 4-hour body closure through a new week opening gap, price has no need to refer to anything that's down here. All of this is balanced, and we're also consolidating here, which gives me conviction that price wants to expand soon. You also have SMT down here. ES failed to sweep liquidity down here, and we have a 4-hour change in the state of delivery up here. So moving forward, I would at most like to see this gap by Wednesday, and if we displace through this gap, I would like to see this weekly fair value gap up here for us to then continue lower during August. Assisty doesn't necessarily require a retest, but if it retests and it closes bullishly like we are right now on the 4-hour, it's a good sign that price wants to continue in the direction that you anticipate it to go. So do you guys have any questions or anything? Because it's like a lot of information to just digest. CRT, I don't personally use it, but I have heard a lot of good things about it. Yeah, you would honestly. Yeah, I would say you want to see a retest just so you have that extra conviction that price wants to go in that direction. So yeah, I'd say you would want to see a retest. Oh yeah, I got you. The manipulation on the 4-hour PO3. I can just do all of July's action since it's been pretty shitty August. Okay, so if we go all the way back to the second week of July, so this is where we actually formed the smart money reversal. So yeah, okay, so we on the first week of July or the second week of July, towards the end of the week, we manipulate higher on Thursday at 8 o'clock. So we most likely had high impact news. So a little tip for you guys when you trade 8:30 news, you want to see what. So this is a sequence you guys want to go when you enter the market. So you want to see whether 8:30 accumulates, which would then lead to a 9:30 manipulation, which is your Judas swing, and then a 10 o'clock distribution. So this is why the 10-hour PO3 works. It's basically due to whatever 9:30 and 8:30 do, 10:30 will base its move off of that. So if 8:30 accumulates, 9:30 will most likely manipulate, and then when our 10-hour or 4-hour PO3 opens for the 10 a.m. candle, it'll most likely continue the trend, or it'll move away from the manipulation move. So this is scenario 1, and then scenario 2 would be where you have an 8:30 manipulation, which we had this day on Thursday. We manipulate up, a 9:30 distribution, and then a 10 o'clock reversal or continuation. So price manipulates higher after we accumulate during Asia and London up here. So this would be your original consolidation. So accumulation, manipulation up here at 8:30. So you would draw your standard deviation leg, and once 9:30 opens, we have this order block over here. 9:30 goes up into the order block, and then we just completely flush. So this day we had a 10 o'clock continuation. So there's two things that 10 o'clock can do. It'll either distribute based off what 8:30 and 9:30 do, or it'll reverse based on, so it's all based on whether or not the higher time frame draw on liquidity was met. So in this case, it wasn't met by 9:30 or 8:30. So 10 o'clock just dumps to the downside, reaches terminus of the market maker model, and we just consolidate throughout the week. Another example would be the following week, or actually Friday's a really good example. We have this accumulation all throughout Thursday, and then Friday 8:30 manipulates. So what would you expect 9:30 to do? Distribute. So we draw our manipulation leg. 9:30 then, so 8:30 dips lower during high impact news, and 9:30 to 9:45 just absolutely rips to the upside, and so does 10 o'clock, since our draw on liquidity, which would be our 15-minute fair value gap up here, or I think it was a 1 hour, yeah, this fat 1 hour fair value gap, and this breaker block. So this was our draw on liquidity, and it wasn't met by 9:30 or 8:30, so we formed the high a day at 1:45, and our 4-hour PO3 was complete at 1:45, and then we dumped to the downside. Monday and Tuesday on this day weren't pretty good, but this is where we formed our smart money reversal up here. We had an SMT, change in the state of delivery down here, and we had a Wednesday expansion. So let's see what the 10 a.m. candle did on Wednesday. So overnight session, we just dumped to the downside. So whenever we have a large Asia or London range, usually you won't get a really good entry during New York, especially if price is in a hurry to get to where it wants to go. So if I mark out $8.30 right here. So 8:30 manipulates into this gap. So after we get an 8:30 manipulation, what do we expect 9:30 to do? Distribute. So we see distribution throughout 9:30, and then 10 o'clock we kind of get a chop towards the opening, and then we have this fair value gap, and 10 o'clock continues the trend until the draw on liquidity was met around here. Same thing on Thursday. If we go to 8:30, you guys can see that 8:30 clearly manipulates to the upside and sweeps these stops up here. So after we get an 8:30 manipulation, what is 9:30 gonna do? Distribute. So we get this fat candle forming a fair value gap, and then the second 10 o'clock opens, we form the high, and then we continue to the downside. So just a little tip, when you guys trade the 10 a.m. PO3, pay attention to what 8:30 and 9:30 do. Check if 8:30 accumulates or manipulates, which will then set the stage for 9:30, which then sets the stage for 10 o'clock. And you really want to align yourself with the economic calendar, because those are the days you want to trade. You don't want to trade the manipulation, you want to trade the distribution. So this week I would avoid Monday, and I would trade Wednesday, Thursday, Friday. I do expect this week to be an open low high close. I don't think we put in the low of the month, I'm not gonna lie. I think these lows will get ran eventually. I just want to see the second and third week of August like print higher, because we want to see August print bearishly. So we want to see an open high low close. You can use any time frame. I'm just using the 15 because it's a bit easier to identify the structure. But I personally like to use the 5-minute chart. Yeah, I got you with the examples for the 830. Yeah, I used to use fair value gaps when I traded options, but it's been a while since I traded options. Backtesting, I am not a big fan of backtesting. I can't lie. Um, Mainly because I feel like when you backtest, you have a lot of prior knowledge of where the markets are gonna head. So I'm not a big fan on, or I'm not really big on backtesting. But I will say, stick to your model and just keep refining it, but just don't completely change it. You should be um, consistently trying to refine your edge, and by that you should, with that in mind, you should be trading really light size once you actually develop a good model. CPI, yeah, I would say Tuesday might be a little low probability, but the markets will wait for CPI, because that'll be the main driver, I'd say, for this week. Yeah, I do trade inverse fair value gaps. Yeah, so I have the timings for Asia and London right here. So Asia session is 8 p.m. EST to 12 o'clock EST. London is 2 a.m. EST to... Actually, let me just send this into chat. How many trades do you take in a week? It usually depends. I aim... If I have a winner, like, in a day, then I'll stop trading. But I usually try to catch 100 points a week on NASDAQ per month, or per week. So once I reach 100 points, then I'm good. Oh, just ignore that. It's just a random thing I had there. It is the ICT kill zones and pivots by TFO. Okay, so more examples of 830. Let's see. My favorite setup. I love trading the 930 or 830 manipulation move. I usually just trade that turtle soup and then I just let the position ride. Let me find a good day. Oh, right here is a good day. So this is a Tuesday. (10 p.m. PO3). I trade that sometimes. How do you trade manipulation? You want to align yourself in the opposite direction of the manipulation. So right here's a good example of where 830 accumulated. So you guys can see 830 mostly accumulated here. 930 forms the Judas swing higher, takes these stops. So you would measure your standard deviations from here, and then we just rip to the downside at 10 o'clock. So this is an example where 830 accumulates, 930 manipulates, and then 10 o'clock distributes. Oh yeah, I'm recording this, so I'll just send it in. I'll send it in general chat. Yeah, I only use, like, no matter what, SMT has to be there for it to be a valid reversal. Like, every reversal starts with a turtle soup and a SMT. Where would my entry be? My entry would be after. Let me go in the 5 minute. So let's say I just wake up, head to the charts. I see 830 just accumulate here. So we just accumulate throughout London, Asia, all over here. So this would be original consolidation. So I would most likely wait to see what 930 does. So given the narrative, I know that this is a false move. So our narrative is what? It's obviously bearish because we formed our smart money reversal all the way up here, and price hasn't met its major draw on liquidity. So given the narrative, this would be a false sweep of lows down here. Actually, it didn't even sweep it. So this would be a false Judas swing. This is a little bit trickier to trade because sometimes 930 will go down and then it'll go up to then set the stage for 10 a.m. during the 950 macro. So we sweep our stop losses up here and we get this change in the state of delivery right here. So once we get this change in the state of delivery, I would enter short right here with my stop above this high, and I would target -1 standard deviation, which is just low hanging fruit. Let me see if there's any liquidity that lines up with that. Yep, down here. This swing low and this swing low would be your draws. So this is a good 5R trade, and you can catch 280 points. 820 to 840. Yeah, that's a really good turtle soup macro. It sets the stage for 830. With FVGs and IFVGs, does it have to be a 3-candle play with the middle candle being the FVG, or if there's 2 candles and both leave FVGs, is that still bad? Usually when I see 2 FVGs or more than 2 FVGs, I go up in time frames. So if there's 2 FVGs on the 15-minute, I usually just check on the or if there's 2 FVGs on the 5-minute, I check on the 15 to see if there's one there. But if not, then I'll use the one that sweeps liquidity. So this one right here would be a valid inverse fair value gap. This one right here. Since this was a fair value gap that was formed when price swept these stops. So this is a fair value gap that you want to use. Yeah, the 830, 930, and 10 also works on Forex. But my favorite macro, I would say, is the 950 to 1010 macro. Any other questions, guys? Because I can answer whatever you guys want. I'm just really trying to help you guys understand how the markets actually move, like based off the market maker models. GU, yeah, is that gold or? Yeah, I'll send the recording in general chat. My favorite firm is 100% Top Step. Wait, could you send me the ticker exactly for GU? My fib settings, I'll send them. When looking for accumulation, what range do you look at? So I really like to trade the 6 a.m. to 12 p.m. 6-hour PO3. Because then I can just divide it into 90-minute quarters. So your first quarter would be 6 o'clock to 7:30. Let me write this down. So 6 a.m. to 12 p.m. 6-hour PO3. So your first 90 minutes would be 6 o'clock to 7:30. Then it would be 7:30 to 9 o'clock to 10:30, and then 10:30 to 12. So you usually want to see whether or not, so based off what 6 o'clock and 7:30 also does, that'll basically move for each one of these. So it will either set up for an AMD X where X would be continuation or reversal, or it could be X AMD, where X would be a continuation again or a reversal of the previous trend. So this is what I usually like to trade. But I also trade the 4-hour PO3. The kill zone indicator, it just shows me like what the weekly open is, where the Asia high or low was placed, the London high or low. It's just more visual. Apex, I do like Apex, but I've heard some sketchy shit from them lately. Can you say why market? I actually don't know that. I think ICT has a video about the IPTA cycles. Let me see if I can. I'll type in the chat. These are very important cycles. They're institutional reference points. MMXM, yeah, I use MMXMs on the lower time frame. So if price is reacting off of a 1 hour fair value gap, let's say, I would like to see a 5-minute market maker model in play. So it's just all time frame alignment. Same goes for the 4 hour. You'd want to see a 15-minute market maker model, and it just keeps going up and up. Oh yeah, this is the change in the state of delivery right here. We close below the 2 up close candles that sweep liquidity up here. So this would be your change in the state of delivery right here. Best to trade for beginners? I would say Silver Bullet. Silver Bullet's really good. I used to use market structure shifts, but a change in the state of delivery is just way better, because your market structure shift would be all the way down here. But I guess since it's pretty close, you can get like a good idea. But the change in the state of delivery will always come before the market structure shift. 10 and 11, yeah. So the reason why the Silver Bullet works is because it is your second stage of distribution. So let's see, I can mark out, so this is your original consolidation. So we mark out these lows. So original consolidation, manipulation, and if we go down to the 5-minute, it's way more obvious. So 930 goes up, manipulates, and then the 950 to 1010 macro gives us this minor change in the state of delivery. So this is more advanced. This is more of a advanced theory that ICT teaches, but based off of this, my eyes are immediately drawn to these lows. Since our narrative is already bearish, anyone who enters off of this fair value gap will get stopped out, because you're essentially pattern trading. If you don't know the narrative, you're just pattern trading. Narrative will always come before patterns, no matter what. So we go up, and 10 o'clock sees distribution lower. So we have this inverse fair value gap. Price inverses this, dumps. Actually, this is not a good day for an example, I can't lie. Let's go to a day where we had a good Silver Bullet. This is a good day. Okay, so we have this 835 manipulation down here. So we have consolidation, accumulation, manipulation, distribution. So we draw our fib right here. 930 opens, drops down into this fair value gap and this order block, and continues higher. So this would be your low risk entry. We then continue distributing until 10 o'clock, where we accumulate. and then we expand again. So your silver bullet would be right here. This would be your silver bullet. We dip down around 1150, so this would be your second stage of distribution, and we distribute into all of these highs up here. I'm not very familiar with the silver bullet. I just know that it works well because it's the second stage of distribution within the market maker model. Okay, so for the change in the state of delivery, it usually occurs after price sweeps liquidity and closes. So for a bullish change in the state of delivery, you want to see price close over either a singular down close candle like we had here, or the series of down close candles. I would much rather prefer this change in the state of delivery, since this one's a very minor one, but this one gives us more conviction that price wants to continue higher. You can also see how we react afterwards at 9:35. We just touch it and continue higher. Okay, so when the narrative is more apparent, so let's see, it wasn't really apparent here, but throughout these weeks, when price, so -2 to 2.5, so none of these levels work unless they have liquidity levels to reference to. So if price closes through this -2 to 2.5 level with bodies, then the terminus of the market maker model will more than likely be reached, because you want to see displacement through this reversal area for it to reach its terminus. So the only way you'd actually know is based off narrative and whether or not we had full body closure through -2, -2.5. Another really good strategy is the MMXM traders Twitter model. That's a really good model to trade. For that, you would only need to trade I'd say 1 or 2 times a week. Any other questions or anything you guys are unclear about? Yeah, URL to IRL is always the basis for my trading model. I start with URL to IRL, and then I look at how the candles close, whether it was a sweep or a run. So a run basically means the candle's closing above liquidity pools. GBP USD. Oh, I actually have the dollar up here too. I don't know what, so I'm guessing the dollar inverse is this, so, I don't really trade Forex, but we are reacting off of this fair value gap down here, and we did sweep this low, so if we take premium discount, we have this fair value gap. So I feel like this could be a valid draw on liquidity, I can't lie. This fair value gap, since we're going from external to internal, this could be your next draw. If I don't have a clear bias, then I'll have something that's, so I would just trade what the market gives me. So I would just head into the day with no bias, and I'll just take whatever the market gives me. So I would just scalp in whichever direction the market's trending. So when a level, so for me, I like to aggressively move my stop. So let's see, like right now we have this Asia session, we have this range. So we can see this fair value gap. So this is where I would most likely place my stop loss, but it is a bit of a fat stop, I can't lie. But if you didn't get into here, if you go down time frames, this is where I would also place my stop, down here. I like to place my stop on the second candle that forms the fair value gap. So we can see this little tiny gap right here. So I like to place it below this, the second candle, because this part of the fair value gap is the most sensitive part of any fair value gap. So for a bearish one, this one would be the most, so the first candle would be your most sensitive point, and for a bullish, the same thing. The high of the first candle that forms it will be your most sensitive point. Yeah, GU looks good for a buy, based off what I just like looked at. It all just comes down to IRL to ERL, ERL to IRL. What's an OWG? I'm not familiar with that. Oh yeah, for MNQ definitely. Oh, and yeah, new week opening gaps, very important. So I have an indicator up here. It's the ICT NWAG NDOG by Fadi. So the thing with new week opening gaps is that they are institutional reference points. So they act as magnets to pull price in the direction that order flow is in. So right now we have, so I told you guys we have this fair value gap that's unmitigated, and look what's resting within it and above it. Two new week opening gaps. So these gaps will act as magnets to pull price because there's a lack of orders within these areas, and these are institutional reference points. And usually when we have a full body closure through these gaps, like we have here when we had this change in the state of delivery, price does not need to go back down into discount for it to reach higher. So what that means is all of this is balanced and price has no need to go down. At most, I'd like to see one of these fair value gaps get filled, but this one I'd like to see treated as a breakaway gap, but this one barely touched into this and continued to the upside. So if we get a 4-hour change in the state of delivery here, I think we just rip to the upside up here. So new week opening gaps, I think you should have at most 5 on your chart. I have 5. I just recently watched an ICT video and he said that you should have at most 5. So I just started doing that. But new week opening gaps and new day opening gaps are literal magnets. I actually don't know that. But I wouldn't be surprised because new week opening gaps are really strong. We also have this new day opening gap up here. So this could act as a magnet as well. Yeah, it's by Fadi as well. He makes really good indicators. Yeah, so narrative, it all honestly just boils down to changes in the state of delivery and whether or not price is balanced. So you guys can see all of these weekly fair value gaps down here. These two were not mitigated. So that's why we had such an aggressive push to the downside, since none of this price action was balanced, because price will only do two things. It will either seek old highs and lows, or it will seek inefficiencies. So these inefficiencies were not fully mitigated. That's why price aggressively moved towards them, swept these lows, and will most likely continue higher until we mitigate this SIBI up here. So that's just basically what narrative is. It's nothing more than that, nothing less than that. It's just as simple as it gets. Um, that really depends. I would say that based off, so obviously you'd have to see whether or not we're in a bull trend or a bear trend. So obviously we've been very bearish on these lower time frames, but if we go to the monthly, you guys can see that we're reacting off of this monthly order block. So on the monthly, I'm still bullish, but the weekly initially I was pretty bearish, but we didn't close below this low right here. So we just swept the stops down there. So I want more upside this week, but so when it comes to the new week opening gaps, you want to see full body closures in the direction of your bias. So since my bias is bullish and we had full 4-hour body closures through the gap, I would like to see price continue higher. But here you guys can see we used it as a resistance point where we tapped into this breaker block. And I think we also had an SMT up here because I remember these equal highs in my draw. We had this SMT, changing the state of delivery, and price reacted off of this new week opening gap breaker and just continued to the downside. So I think it just really depends on narrative. I started trading ICT 5 months ago. I think I'm approaching 6. Yeah, so 8:30, 9:30, and 10. So each one of these times sets the road for the other. So you can either see an 8:30 accumulation, which would be a 9:30 manipulation into a 10 distribution, or you'll see an 8:30 manipulation, which it usually happens when we have news. 9:30 distribution, and then a 10 o'clock reversal or continuation. So this all depends on whether or not your draw on liquidity was met. Yeah, they are. The times are in EST. Yeah, I would expect a reaction. Like right now, we are reacting off of the NWOG. They're just reference points, so price will most definitely react. I expect a reaction up here, up here, up here. Yeah, I feel like not a lot of people really talk about how important these times are. These are very key times. I think I just got pointed in the right direction. I don't know if many of you guys know who Afiz is, but that guy really helped me learn a lot. Yeah, ICT. I think he's gonna touch on these times. I feel like, 8:30, 9:30, 10. Because I tapped into one of his lectures and he was talking about I think 6, 7, 8, 9, 9, 10. Yeah, sometimes 8:30 does like just push up, and usually I just align myself with the 8:50 macro when that happens because that usually sets the stage for 9:30. Because 9:30 will like when 8:30 sees an expansion, 9:30 will go lower into either an FVG or have a stop run and then continue in the overall direction of the trend. Yeah, I actually don't know. I think I'm just a fast learner, but I think Afiz, let me type his name. Yeah, he really helped a lot. Does MNQ and NQ move the same? Okay, yeah, so this is a big problem I think for a lot of people. So if you go to NQ, so the difference between MNQU and MNQ is that MNQU is the current contract. So you go to NQ or MNQ and you want to click this, adjust for contract changes, because for some people this low, look, if I have this off, you can see this low was not swept, but if you turn this on, it was swept. It's just a little thing, I think, that's annoying. Yeah, 830, quarterly theory, I did use it for a while. I just think it really helps to visualize AMDX or XAMD. Like, it works, but it's more of like a visual aid, I would say, for XAMD, AMDX, because 830 it's aligned with the manipulation quarter or the accumulation quarter, because it can be either AMDX or XAMD. That's why 6 to 730 should also be something you guys should look at. But I really do like quarterly theory. Yeah, no problem. It's not on MNQU or NQU. It's gonna be on just NQ or MNQ. Yeah, of course. I mean, if you guys trade the 10 o'clock BO3, it just opened, so. Yeah, I like to use just the NQ chart for long term, because it's a bit funky with like the contract changes and whatnot. Oh no, don't worry about that. I'll send it in general chat. Don't worry about it. Yeah, I do use seasonal tendencies. That's why I want to see a open, high, low, close for August, because I know August and September are usually really bearish months. Yeah, because usually you want to see the high of day or the New York AM session high or low be put in by 10:30 to 11, and then the 10:50 macro usually provides a reversal. It all depends on whether or not the draw on liquidity was met. So usually you'd want to see a 10:50 11:10 macro reversal. It all depends on draw on liquidity. But I would say the best macro to trade would be the 9:50 to 10:10 macro. Oh nah, I don't know anything about that. I don't think you can, bro. You might just have to redo them. Yeah, 10:50 is a good time to trade. I've also been getting a little into PM session. The PM sets up nicely sometimes. Like Friday, I think Friday had a really nice move during the PM. Yeah, I think I caught this. I think, yeah, 12:15 we had a good move. Yeah. But last week wasn't really good because it was the first week of a historically bad month. You guys can just see we have this 3 drives pattern, dip to the downside, and then push up. Also, another thing, wicks. Wicks are very important. Look at this daily wick right here. So I usually like to divide wicks into quadrants. Oh, why is it doing that? Here. So you guys can see how price reacted off 50% of this wick. We went up. So wicks are inefficiencies to market makers. So this week I'd like to see us respect around 25 to 50% of this weekly wick, which also lines up with these two inefficiencies. So that's another reason why I'm very bullish this week. What's DRIDR? Yeah, the wicks are something you guys should know about. Very, very good. No, I treat them like inefficiencies. So the same as in FVG, you don't want to see more than 50%, a body closure below or above more than 50%. No, I don't trade defining range. Also, rejection blocks are very, very powerful tools. Right here, you guys can see this rejection block. Price dips down, continues up. Rejection blocks are really good. Okay, so there's two types of macros. You're gonna have your regular macros, which are gonna be the last 10 minutes. Last 10 minutes to first 10 minutes. And then your second type of macro will be your turtle soup macro. So people usually trade this one. It's going to be the, I think, first 20 to last 20. These are your two types of macros. But I would say that the correct times are 8:50, 10, 9:10, 9:50, 10:10, etc. I only use order blocks and fair value gaps. Okay, rejection blocks are, so I don't really know how to explain them well, but they're basically just areas where price failed to push lower, but it respects the actually I really don't know how to explain this. I just have like this weird definition in my head. So you guys can see how like we wick this area a lot, and like I said, wicks are inefficiencies. So this right here would be your rejection block, since price is rejecting off of this wick and failing to close below. There are a bunch of orders that are down here waiting to be filled within the wick. So price will treat this as an order block. I think it's more clear on the 6 hour. Yeah. See how like we create these long wicks and price rejects off of it on Wednesday? I would say watch T-Trade's video on them. That guy really has some good explanations. Oh, I don't know anything about that. But whole numbers, I do remember from like when I traded options, whole numbers were good areas to trade. Like 580, 585. I guess that makes sense. But I don't really trade that concept, no. Yeah, no problem. Any other questions? Yeah, so IPTA, I think, I don't think, I might botch this. Inter something price delivery algorithm. Oh, the interbank price delivery algorithm. So there are, so like I was explaining with the market maker models, so we had this original consolidation down here. So the market will move. This is how the markets move. The market maker models are the lifeblood of the markets. So original consolidation, accumulation 1, accumulation 2, and then we eventually reach terminus of the market maker model up here, right? So this would be your smart money reversal. And once we get a significant market structure shift to the downside, I immediately start looking 20 days back. So down here was your market structure shift. So this down close candle on the 17th, mark this out. And then you go back 20 days. So 20 days would be June 17th. And then these are your IPTA 20 lows. So these are IPTA 20 lows because you're looking back 20 days to these lows since we got a significant market structure shift on the daily. And then you look back another 20 days to May 17th and you have these lows down here. This was your IPTA 4-day. And then you look back another 20 days until you reach your original consolidation and you have your IPTA 60 lows. That's why we had such a violent push to the downside, because price was in a rush to get to its original consolidation. With my I usually trade the 5 to 15 minute market maker model. It's just the best for intraday because you want to look for a one hour fair value gap or a 1 hour liquidity pool and then frame a 5 minute market maker model out of that. But the 4 hour, because I also like to trade the 4 hour market maker model, mainly because we react off of a weekly level in which you want to see a 4 hour market maker model, and then within that 4 hour market maker model there will be a 15 minute market maker model. Yeah, so you mark out the IPTAs once there's a huge market structure shift, exactly. In this case it was on the daily. This week I want more bullishness. This is my first draw on liquidity. 19064. But at most I want to see this fair value gap. I think it also aligns with some standard deviations. Yeah, you can see if we manage to displace through this 4 hour gap, at most I would like to see this weekly fair value gap. But I wouldn't be surprised if we saw new all-time highs. This market's just weird as fuck. But yeah, I'm more leaning towards bullishness this week. And for the IPTA, I think I would recommend watching ICT's video on them. I think he has a few talking about the algo. But if you guys have no more questions, I might have to call it. I have some stuff to do later. But I'll send the recording in general chat, and I'll send it over to Key as well, so he can post it. Yeah, no problem. No problem, guys, no problem. So yeah, I'll post a video and I'll catch you guys another time.